Ted Peters has had a remarkable career. He started 2 successful banks from scratch, one out of his basement, and then went on to lead Bryn Mawr Trust to record operating results for 14 years. He served on the Federal Reserve of Philadelphia and has worked with the likes of Janet Yellen and Ben Bernanke. He now runs a hedge fund called the Community Financial Institutions Fund with his partner, Jason O'Donnell, who is regarded as the top banking analyst in the country. You put together a former successful bank CEO with a top bank analyst, and what you have is a team capable of analyzing the banks and their portfolio from just about every angle. Their fund is unique. It invests primarily in microcap bank stocks. These are the banks you've probably never heard of, and this is where the market is inefficient and information is scarce, and that translates to opportunity for their investors. Ted has a great story to share. This is our conversation with Ted Peters.
Welcome to the Invest Smarter podcast, where we'll simplify investing and provide actionable ideas to help you navigate the markets and own your future. From retirement planning strategies in plain English to timeless investing wisdom, we'll cut through the noise and leave you a smarter investor by the end of every show. All content within the podcast is for informational purposes only and should not be relied upon for investment decision making.
We have Ted Peters, former president of Bryn Mawr Trust. The performance of that bank during that time was really fantastic. Ted has a community financial institutions fund, which we'll get to a bit later. But to begin with, I'd like to say good morning, Ted Peters. How are you today?
Dave, good morning. First of all, thank you for having me on your show here. You and I have known each other for a long time, 25 years or more. So it's just great to be with you and do this. Thank you.
Yeah, no, it's really great. What we've been doing with the podcast is trying to get a hold of people that have had really interesting careers and try to learn something from, experiences that you've had. So why don't we start with how did you get into banking?
Well, you and I went to the same school. I was a little secondary school. I was a little ahead of you. And I was a peace love Woodstock child in a sense that, going to college during the late 60s and early 70s. So when I got out of college, I actually taught school for 4 years, taught and coached for 4 years, and really enjoyed it. Actually, I taught at the same school you and I went to. But I knew I wasn't an academic, and that wasn't going to be my career. So I got into banking. I was very fortunate. I got into the commercial lending training program at Philadelphia National Bank. They had a lot of classroom work as well as on-the-job training and so forth. And that's how I started my career as a commercial lending lender, lending to businesses and so forth. And I was fortunate. Everybody I worked for either got fired or quit. So I went up the ladder a little sooner than I probably should have. So that's how I got involved with banking. Went to a couple other banks, and then I think in 1985 I got involved with a group of. We started a bank in Wayne in 1985 called National Bank of the Main Line. We had no idea what we were doing. there were 12 of us. I was the CEO, and the others were all the outside investors and directors. And we raised, this is hard to believe, we only raised $2.1 million, and they let us open the bank. And we grew the bank pretty quickly. We grew it up to almost $300 million, and we sold the bank. And it was a good investment for everybody. We sold it 7 years later for 6x. So it was a nice investment.
That's a fantastic return.
Yeah. So that's how that's the early part of my banking career. There's other parts of the career, but
National Bank of the Main Line. So that really that does bring back some memories that I do recall.
Yeah, we used to do a lot of corny cable TV ads back then because we were really just a sort of a mainline bank. So we were in Radnor and Lower Merion and Tredyffrin, Easttown, and so we were fortunate you could buy a lot of cable ads and really just do those townships. Now they don't let you do it as specifically, and so we used to do we used to saturate, but we do a lot of cable TV commercials, mainly on ESPN and some other stations. So we had a lot of fun with it. So
that sounds like a great start. So that was from 1985 till the time you sold the bank.
Yeah, we sold the bank in '92. I hung around for 3 years, and then I was able to get my employment contract ended and my non-compete, and I then started another bank called First Mainline Bank, which quite frankly was a total clone of National Bank of the Main Line. And at National Bank of the Main Line and First Mainline Bank, all we did was closely held small businesses and some private banking, stuff. And we were very, very simple. And I always kind of say in my career, I kept it simple because I wasn't smart enough to keep it complicated. And it actually has worked out. It's worked out very well for us. So we did the same thing. We started in 1995. We started First Mainline Bank, a lot of the same directors. We were actually headquartered in St. David's. We grew the thing to about 250, 300 million again after 6 or 7 years. And then we merged it into National Penn Bank at that time, which is now, I think, BB&T. And at that point, I left and joined Bryn Mawr Trust. Their CEO, Bob Stevens, who was a terrific guy, he was retired after 41 years. And I threw my hat in the ring, and I was very fortunate. I got that position. I was chairman. I think, as you know, I was chairman and CEO and president of Bryn Mawr Trust for 14 years, almost exactly 14 years.
So what year did you start at Bryn Mawr then?
Bryn Mawr, I started in January 2001, and I left technically legally January 1st, 2015. So it was a great run. We were fortunate. We had 14 years of record operating earnings, and the stock was up 300% versus our index, which was remember 2008-9 was only 50. So bank stocks were up 50% over that 14-year period. We were up 300%. So we had a great run. It was really it was a lot of fun. It was a lot of work. And then in after I left Bryn Mawr Trust, I was a little tired of working 65 hours a week and having 400 people and 5 meetings a day and all that stuff. So I knew I couldn't retire. So I hooked up with Jason O'Donnell, who was an analyst who covered Bryn Mawr Trust. He was with Betty and Scattergood, and we decided to start a hedge fund. So that's what I'm doing right now, running a fund called Community Financial Institutions Fund, which invests in micro cap bank stocks around the country. So it's a lot of fun. We're headquartered in Wayne here. It's just Jason and I. We subcontract everything out. All our back office, all our administrative stuff is all subbed out. And our performance, if I can knock on some wood here, has been, if I could say, very good over the 6 years that we've been running this. We have about 90 investors, about $65 million, including the fund and some separately managed accounts. And we're having a good year so far. We're up, we just got the results for April. We're up about 18.8% for the year, and hopefully
that's great. That's
hopefully we can keep it going. But we do think, David, there's a lot of room in microcap bank stocks.
Let me ask you this: up until the time when you left Bryn Mawr, what do you think were some of your most memorable moments? And it could be anything. It could be you were with the Philadelphia Federal Reserve. You had meetings with Janet Yellen. So what do you remember? What's memorable about that whole period to you?
Well, I think a couple things. One, going to the banking thing, memorable was 2008-9, which was really, really tough. I mean, we came very close to being in a depression in this country. We were certainly in a deep recession. So we were getting through that period and working with clients and so forth. We were fortunate at Bryn Mawr. We had very few problems, almost no problems. A lot of banks had a lot more. So that was very trying. Also, when I got to Bryn Mawr, we really needed to grow the bank. The bank had not been growing much. So when I came in there, we had a little over 400 million in assets and only 5 branches. Hadn't built a branch in 16 years or 17 years. So we immediately started building branches and started growing the bank and expanding. And when I left 14 years later, we had, I think it was 29 branches, and about 3 billion in assets. So a banking asset. So we had some growth. So I think the memorable things in the banking career were really growing the bank and putting in a growth strategy and growth philosophy, and also getting through 2008-9 relatively unscathed, which we're some wood to knock on.
There was a lot of big banks that went under or nearly went under.
Without a doubt. Oh no, I mean, and we didn't take TARP money. A lot of banks did and should have, but there were a lot of banks. I mean, we had 2 or 3 banks, 2 or 3 loans we had some problems with. Larger loans we had some problems with, and worked our way through. Most banks our size had 22, 23 bad loans they were working through. So we were fortunate. We did a lot of real estate lending to some of the well-known builders, developers on the main line, and they saw this coming. They saw the recession coming, and they actually started to downsize. They stopped building $3 million spec homes and started building cluster housing and things on a lower price point. So we were fortunate in our our stable of builders. We had about 9 builders, really well-known mainline builders, and they all saw this coming, and they kind of downsized. So we got through this thing pretty well. The other memorable thing you mentioned it very briefly was the Federal Reserve. And I was elected to the board in my first day there was January 1st, 2009. And what do you think was hitting right then?
Oh my God, yeah.
And as you know, in March 2009 was the complete nadir of the stock market. The Dow got down to, I don't know what it was, 6,000 or 7,000. There's not a crazy number.
A lot.
And I would have people come up to me, and smart people like you, David, and they would say, "Geez, Ted, this is awful. You're going on the board when it's during a recession. It can't be much fun." I said, "No, it's the exact opposite. It's like really fun because you're down there. We met. This is hard to believe. We had 12 in-person meetings a year, and we had 12 phone meetings a year. We had 24 board meetings a year. You had to by law because we had to set the discount rate every 2 weeks." So we were meeting regularly, and our president was on FOMC for much of that term. So he was a voting member, Charles Plosser. And then I was chairman of the audit committee. So I was down in Washington a lot, because if you're the chairman of your Federal Reserve District's audit committee, you're automatically on the audit committee of the big Fed down in Washington, which we called, I can't remember the exact name of it, but it's sort of the Council of Audit Chairs, but it really was the audit committee for the whole Fed, the big Fed. So I was down in Washington a lot, and it was sort of fun. I had a one-on-one with Bernanke one time, just talking to him at a cocktail party. I had dinner with Janet Yellen, just Janet and I and one other person. She's a delightful person, and obviously she and Bernanke, these people are extremely, extremely bright. And so no, it was a great experience.
But you were in it right in the middle of when everything hit the fan.
Oh, we took our bounce sheet from 500 billion to about 4.6 trillion when I was there. And rates just were dropping through the roof, and it was exhilarating. And the Fed, basically between the Fed and the Treasury, they came up with about 12 different programs for the recession. Probably 3 or 4 were very effective. TARP included, guaranteeing commercial paper, guaranteeing business deposits, extremely successful for stabilizing the market. 3 or 4 were somewhat helpful. 5 or 6 did absolutely nothing. But I can tell you right now, David, and to your listeners, if the Fed and Treasury had not acted aggressively, which they did, we would have gone into a depression. Absolutely. And they stabilized the market. Yeah, they stabilized the market. They added liquidity in the market. They added confidence in the market, and we got through this thing. Very well. So it was 6 years. I was always proud of myself. I never missed a meeting in 6 years. So I don't know many people that did that. But I was very proud of myself.
That's great.
On doing that. It was a lot of fun. I realized very quickly, however, I didn't really have a lot of power or authority on the board of the Philadelphia Fed. However, being kind of an insider was fun. I mean, Charles Plosser, our president, would come back from Washington and go, "Yeah, I was talking to Ben, and Ben told me this about rates and that about rates." And, and then after he did, Janet was the head. You go, "Yeah, Janet and I was talking to Janet. She said we're going to do this or that." And of course, quite frankly, I mean, we knew what was going to happen to rates before the general public did. So, I mean, obviously nobody ever would have done anything, but you knew what was going to happen. I mean, you knew if for some reason they were going to raise rates or lower rates or whatever, sort of before everybody else. So it was kind of fun feeling like a little bit of an insider, David.
Sure.
Not under any impression that I had a lot of power or authority, but it was fun feeling a little bit like an insider.
Yeah. So when you met with Janet Yellen, what were your impressions of her?
Well, once again, she's not tall. She's about 5 feet tall at that. And I have a picture of she and I standing there, and she, she's about a foot and a half shorter than me or whatever. She's a delightful person, much different than Ben. Ben Bernanke was quiet, reserved. He was really an introvert. I remember I went up to and I shook hands, sort of, and he sort of almost recoiled on me. Not recoiled, And Janet, you go up and see Janet. She comes and she puts her arm on your shoulder, and she, I have a picture of she and I were kind of snuggling in the picture.
I want to see that picture.
Yeah. I have the picture. I'll send it to you. And she is, and she and Bernanke, they're just, these people are so smart. I mean, their IQ is easily twice mine. And so it was delightful to have dinner with her one-on-one one time, and then see her other times, because a lot of times we go down to Washington, they'd have a little reception. Like, we'd be down there for an audit committee meeting, and we'd have the meeting for 2 or 3 hours or something. And afterwards, they'd have a little reception, and some of the governors would come in, including Janet. They would just sort of stop in and have a drink and say, hey, to see what was going on. I mean, they didn't have to, but they really did. So.
Yeah, I think that would have been a wonderful experience. I recall the Great Recession when the money market funds broke $1. I guess when Lehman Brothers went into bankruptcy. And I remember I was playing tennis in the afternoon, and I heard this, and I said, oh my God, this is disastrous.
Yeah.
And then they backed money market funds. And that was either, I don't know if that was Bernanke or
that was Bernanke at first. It was Bernanke at first, absolutely.
Yeah.
I mean,
and
it was ahead of when it hit the fan. Bernanke was the head guy. So and the Fed acted very aggressively, and which they should, and the Treasury acted aggressively too. I mean, TARP was a huge thing. Not as TARP saved the car companies. I mean, I'm trying to remember. I don't think Ford took it, but General Motors and Chrysler and they never would have survived without TARP money.
And just for a reminder, because this was 11 or 12 years ago, TARP stood for what?
A Troubled Asset Recovery Program.
Okay.
It really didn't have much to do with that. It just basically was giving money to people who were in trouble, and then they had to pay it back. TARP was a huge success. I mean, the government got almost all of its money back plus interest. So it was one of those few government programs that actually they made money on it. I mean, I'm not not all government programs do that. So the TARP was a huge success, and it helped a lot of banks too. I mean, all the big banks took it, and it was a great thing. I mean, but it's I think it was Troubled Asset Recovery Program. I'm pretty sure there were a lot of acronyms back then, David, and I can't remember them all. So.
Okay, so let's look back at your career before we go into the Community Financial Institutions Fund. What would you say was your greatest success in your entire banking career?
Well, I think starting 2 banks from scratch. I mean, literally the first bank we started in my basement in the formative stage, and when we were raising money and trying to get a charter, it was literally in my basement. We had a little office, and we opened a bank, and once again didn't really know what we were doing, but we grew it and made a lot of money. It was great for our investors. The second bank, believe it or not, I opened on top of a Subway hoagie store, whatever you call them, out in Paoli. Okay. And once again, in the organizational phase, that's where we were. We were raising the money, doing all that kind of stuff that you have to do. And then we got that open. Okay. So sort of starting things from scratch. The great thing about starting things from scratch, and you've done this, David, you have your own business, is if you fail, you fail. It's only you. You can't blame anybody else. And if you do well, you can take the credit. It's not like coming in and some established business and all this kind of. It's great to start something up. And and I mean, National Bank, the main line. The 12 of us, we came away from that thing 7 years later going, we all worked hard and we did it, and we kind of made it work. So I think that was the big thing. The other thing, of course, was going to Bryn Mawr, which I mentioned, which had been very, very, had not grown. It was growing about 0.5% a year, and it just really it was a wonderful bank, but it just hadn't been doing too much, and it fought off a couple of takeover attempts early in the early 90s, and to take that bank and to just grow it, and it was and to make it once again go from 5 branches to 29 branches and 400 million to 3 billion, and we took the wealth business from about $1.2 billion to about 7 billion wealth management business. So we kind of grew everything, and we had a good time. I mean, we had a good time doing it. I was very fortunate. I always had great direct reports. Sometimes when the higher you get up the feeding chain, you realize that your job is more about selecting people to work for you or with you than it is about some other things. So I always had wonderful people, either ran operations or they ran the wealth business, or they ran commercial lending and so forth. So
your advice to people trying to build a business is
keep it simple and work hard, have a niche. If you're going to, I don't care what business you're going to start in, but you have to fill a need. Whether you're opening a restaurant, or you're opening a stationery store, or you're opening a manufacturing facility, you have to fill a need. So fill that need and keep it simple. I mean, you can always get it complicated later on, or more complicated and more complex. Believe it or not, one of the worst people to start businesses are engineers. because they're anal. Everything has to be perfect. They overanalyze everything. They can't get anything going unless everything's, and to get it, what you need to do when you start a business is, it's a Chevy. Make it a Chevy. Get it up. Get it running. Get it going. Then you can fine tune it, turn it into an Oldsmobile. And then you can fine tune it, turn it into a Caddy. Then you fine tune it again and turn it into a Mercedes, whatever you want to do. But I mean,
turn it into a Corvette. But,
you turn it into a Corvette, which you probably drive.
So from what you said, is keep it simple, work hard, and get smart people to work for you. Get good.
Exactly.
Clients.
And then it all comes down to the client. I always used to say at Bryn Mawr, take care of the client. Everything else will take care of ourselves. Everything will take care of itself. Every place I was with the banks, we don't have customers, we have clients. We add value. If you don't add value, you're a commodity. And then you work on price. Mm-hmm. So we have clients, just like David. You have clients as a money manager. Lawyers have clients. CPAs have clients. So when I came to Bryn Mawr, and the other banks we get it too. We don't have customers. We have clients. We're adding value to we have a relationship. We're adding value.
Yeah, Bryn Mawr Trust was. My mom banked there. Her friends banked there.
Yeah.
It seemed to bank there that was long-term mainline people. And I guess recently the bank was acquired. So do you care to pontificate on what happened there?
Yeah, well, first of all, I'll go back to the word mainline. When I got there, I took the word mainline out of everything that was in any literature or advertisement, because I didn't want to be a mainline bank. I wanted to be a Western suburbs bank and even get into Philadelphia. So we took that out of it. I kind of joke at Bryn Mawr, our best customers had vowels at the end of their name. We dealt with entrepreneurs, people owned and operated their own business. And we have Mrs. Pugh from Marion Cricket Club, who came over in the afternoon and cashed a check. Of course, we had all those clients. But our clients were basically entrepreneur business people a lot of them were tough people, great people. We also had a very large minority population of clients, more than any other bank. In fact, almost all the black churches up and down the main line dealt with us, mainly because Bryn Mawr Trust was a place where all people could get great service over many years. So we kind of took so we weren't a mainline bank. We were basically a Western suburbs bank. We kind of did that right away. What was the second part of your question? I'm trying to think.
Well, it was recently acquired by.
Yeah, right. Well, this is obviously I personally was very, very upset about this. I think a lot of people were. Bryn Mawr Trust was an institution. It had a great cachet. It was a nationally known institution. Selling. I'm not knocking WisFis. Bryn Mawr Trust is selling to WisFis, and it's going to close in December, I think. But I'm not knocking WisFis because they're a good outfit. But this is like selling Bryn Mawr Trust to WisFis is like selling Marion Golf Club to Club Corp of America or something. It's really, that's actually probably a perfect analogy. And unfortunately, the current management team couldn't make it work, and the stock didn't do overly well, and the earnings weren't great. And I guess they decided they had to sell. But it's really a shame. It'd be like selling also. Okay, you remember Marion Cricket Club? You're a member there, David. It'd be like selling Marion Cricket Club to Club Corp of America.
To what? To who? What?
Club Corp of America. You know Club Corp of America is? No, they go around and buy clubs and country clubs and stuff, and they sort of turn them into semi-private kind of institutions. But it's just a shame. It is what it is. I'm upset. A lot of people are upset. But it is what it is, and you're going to move on in life. It's kind of interesting because what I do for a living right now, we like to see banks sold. So if we own a bank, we like to see it sold for obvious reasons because we make more money. But in this case, I'm separating my personal feelings and my business feelings.
I guess did your fund own Bryn Mawr Bank?
We did not. No, we never owned Bryn Mawr Trust. I just thought that was a conflict. I still own some.
Sure. That would. Yeah.
It was just a conflict. I knew too many people there. I wouldn't want anybody ever to say we ever did anything on information we shouldn't have. So we never, and we're very careful about that kind of stuff.
Okay. So I want to talk about the Community Financial Institutions Fund. I just have one last question. Where do you see the economy now, and inflation potential, and how? What do you see for like the next 3 to 5 years?
Well, the economy obviously has been juiced up quite a bit with all these stimulus programs we've had, and we've had the $1.9 trillion program. We're now talking this huge infrastructure program, which will probably be downsized pretty sharply because they can't get all the Democratic senators to go with it. So the economy's doing very well. It's doing great. Unfortunately, the biggest problem right now is employers can't find people to work for them. And I've talked to literally almost dozens of people who own small businesses, contracting firms, and any kind of small business. They can't find people to work for. And it's very simple. People are making more money on unemployment. I've talked to people on unemployment. They go, I'm not looking for a job. I'm making 600 plus 300. I'm making more money on unemployment. And that doesn't resonate to people listening to this podcast or you and I, because we're career oriented and we want to go out and work hard and do well for other people as well as ourselves. But this is a major impediment. That's the reason. To me, is the major reason the jobs report was so poor a couple of days ago. And so we'll see what can happen, but we're going to get through that, and we're going to get through that, and the economy's going to do fine. One thing we do have, inflation has got to loom out there. We're literally printing money right now. The Treasury issues debt. And the Federal Reserve buys the debt, and of course the Federal Reserve prints money. Federal Reserve can print money. They just create a debt credit. They break the securities in. They buy the security. They create a credit. And now you just double your money supply. And then all of the interest, all of the profit of the Federal Reserve Bank, which is about 98% of its revenue, goes back to the Treasury. So we're monetizing the debt. The Treasury is issuing debt with almost no cost because the Fed's buying a lot of it, most of it, and they're giving all the interest back to the Treasury. So unfortunately, when you have this much, you increase the money supply as much as we've increased it, you're going to end up with some inflation. There's got to be inflationary pressures at some point.
Well, you look at the price of lumber or copper, or even P&G said they're going to raise prices. So, we haven't seen inflation for a while, and maybe, we don't know what's coming really. And I know the Federal Reserve is saying, hey, we're going to keep rates at zero, but, we'll see.
Hopefully it won't be. I lived through inflation. You were probably still in grade school, David.
No, I was not, and I did live through inflation.
I lived through inflation in the early 80s when literally 12-13% was the CPI every year. Bank CDs were 16%. I had a 16% mortgage at one point. And so I don't think we're ever going to go back to that. But then Volcker came in and shut everything down. But no, it's I think it's going to kind of some inflation is good. The Fed's target for inflation is 2%. So if you have inflation 2.25%, that's fine. It gives companies pricing power and things like that. But I think we just have to be careful with it. But the Fed's responsibility is really price stability, which is inflation and full employment. So they're looking at that very closely. I can tell you, however, Janet Yellen and Janet Yellen's a Keynesian, by the way, but Janet Yellen and those people, all they have is the country's interest at heart down there. Janet Yellen makes, I think, $200,000 a year as head of when she was head of the Fed. Treasury, I think she makes the same thing. Powell is now head of the Federal Reserve, makes a couple $100,000 a year. These people go to Wall Street and make a huge amount of money, and they don't do it because they really care for the best thing. So, we have to keep politics out of it. Every president comes in. It's not just Republicans and Democrats. Or it's not just Republicans. It's both. Democrats do it as well. And they come in. They all want to try to politicize the Fed. They all want to get change rules and change appointees and do all these kinds of things. And we can't politicize the Fed because that would be a disaster in the long term.
Yeah. Well, listen, I could ask you a lot of questions about the Federal Reserve and printing money and the Treasury doing what they do and the Fed doing what they do, but we would never get to the topic I want to get to, which is your Community Financial Institutions Fund. And so I wanted to know what was your thinking and how does this work and who you're what is the reason? I know that you're in microcap banking, so can you tell us why at this point that microcap banking makes sense?
Yeah, well, when we started the fund, we knew it was going to be in banks because that's what I knew. That's what Jason knew. And Jason O'Donnell, my business partner, who's the chief investment officer, was twice. He's maybe the number one bank analyst in the country. He was voted that twice by his peers a number of years ago. So we decided to start a bank fund. And then the next question was, what are we going to be in all banks? Are we going to be in what we call SMID, small, mid-size, mid-cap, large? What are we going to be in? And we finally decided that we wanted to be in really micro cap bank stocks for a couple of reasons. One, it was more inefficient market. If you start buying Citibank and JP Morgan, I mean, they have 50 analysts and perfect information out there. But a lot of the banks we buy don't have any analysts covering them. People don't visit them as much. And we first of all, we don't buy a bank unless we meet with management and very often have face-to-face meetings with them. Mm-hmm. Now, COVID hurt that a little bit about going out and actually sitting in their offices. But I mean, we've gotten on a plane and flown to California to meet a bank, or flown down to North Carolina. We do microcap bank stocks. Most of our banks have assets between 800 million and 2 billion. They trade, probably 2/3 of our banks trade on NASDAQ, about a third over the counter. There's not a huge amount of liquidity in them. So we usually buy them in bulk through investment banking firm, KBW or Raymond James. Will put in orders. If we went in and put orders in, we would be the market for some of these banks.
Right.
So we'll buy 100,000 shares of ABC, but we do it in bulk. We find directors that want to sell, large investors that want to sell, things of that nature. Even though we do have liquidity in our fund, we have it analyzed every quarter, and we know we can liquidate the fund within a very reasonable period of time. So Jason is excellent, and so what we do, we have different skills. Jason's very analytical, very bright guy. He does the bottoms up, and I do the top down. So my interest is in management, quality of the management. What's their vision? What are their strategies? What are they going to do? What are their tactics? What are they going to do if it doesn't work? Jason is more of a bottoms up analytical kind of guy. And then we meet in the middle. We don't buy or sell any stocks unless we both agree to it. We run a concentrated portfolio. Usually we have 15, 16, 17 names at most. Our feeling is you can't add value unless you have a concentrated portfolio. Mm-hmm. If you own 50, 60, or 100 names, you're just an index fund, in our opinion. So we run a concentrated portfolio of banks we all know very well. Our average carrying time is maybe 2 to 3 years. Mm-hmm. I would say probably a third to half our portfolio were takeover targets. Mm-hmm. And a couple of our years, if you look at our results, a couple of our years have been very, very good. I mean, all our years, I think, we're pretty happy with all our years, but a couple of them because we've had some takeovers. So if we can get we can just pick, we can pick good stocks that are undervalued in the market, and we get 1 or 2 banks taken over every year or two, we're gonna have pretty good results.
Do you tell us a little bit about Jason, his background, and how you came together?
Yeah, Jason has been a bank analyst for probably 15, 18 years. Started out with Ryan Beck, went to Betty and Scattergood, where he was head of research for banks. And Jason covered Bryn Mawr Trust. So we would do what we call road shows together, non-deal road shows. So Jason and I would go to Baltimore for a day or two. We'd go to Boston, or we'd go to somewhere, Chicago, and we would call on investors that might want to buy us. So by Bryn Mawr Bancorp, which owned Bryn Mawr Trust. So we got to know Jason, and I knew it when I left Bryn Mawr. I gave the board 3 years notice. And so I told him, I said, "Well, I'm 65, I'm out of here." And so I gave 3 years notice. So Jason and I started chatting a little bit. I go, "Jason, I don't know, I'm thinking of starting a hedge fund after I leave Bryn Mawr. Do you want to join me?" And we'll be partners, business partners, 50-50 business partners. And to his credit, he's got a nice entrepreneurial streak in him. I mean, to me, I'd start a few businesses, so it didn't matter to me. And but Jason, not everybody wants to, he's got a wife and 3 kids and all that kind of stuff. So not everybody wants to leave that secure job with a paycheck and health benefits and all the other kind of stuff. But to Jason's credit, he jumped in there, and once again, we've done very well, and large part to Jason. He's once again the #1 bank analyst in the country. So
that's what impressed me, is that you hooked up with the #1 bank analyst in the country.
Yeah.
That's impressive. Yeah. That's impressive.
Yeah.
So you have a couple of banks that you think are takeover candidates?
Well, yeah, we've got a few that are pretty good. I mean, we have a couple. I'll talk about some local banks, which your people might know. We like Malvern Bank out in Malvern. We think that's definitely a takeover target. There's some activists in there, and we like having activists in there making some noise and stuff. So we like that bank. We think that bank's going to be sold within the next year to 18 months. The other bank, also a Philadelphia bank, is we like Prudential Bancorp down in Philadelphia. They're very heavy in sort of South Philadelphia, which is now been a really hot area the last 10 or 15 years. There are a number of banks who might want to get into Philadelphia, like Fulton Bank, we think is an example, and some others, who may want to get in there. So no, we like. So there are a couple of local banks which we like. We own banks. I don't want to say too many of our names for obvious reasons.
No. You don't have to spill all the beans here. But,
yeah. But no, in general, those are two local banks which your listeners may recognize.
Malvern for sure. I didn't know that. Prudential, to me, I didn't know about Prudential, but Prudential I thought was an insurance company.
Yeah, well, Prudential is the old Prudential Savings and Loan in South Philadelphia. So it's about $1.2 billion, $1.3 billion. No relation, of course, to the other. But once again, there's some activists in there. We think they're sellers as well.
So who would be the who? Okay, so for a generalist investor who would want to participate in this, what would be your typical investor?
Well, our typical investor is an individual who's been very successful in his or her field, whether they be medicine or whether they be a builder or a contractor or they had a business or something like that. Net worth between 10 million, and we have some investor or two close to $1 billion for net worth, and we're a small part of their portfolio. And they sort of like the story. Banks are combining. When I first got in banking, there were over 20,000 banks. There's now about 4,800. If you define.
Can you speak that? Because that sounds like an incredible reduction.
It's an incredible number. It's just every single year more and more banks get taken over. So I think it'll probably level off around 3,500, something like that, because there are a lot of family-owned banks in the Midwest and so forth who will stay as family-owned banks. But no, there's still going to continue consolidation in the industry. We think there's probably COVID slowed it down last year a lot. We think this year we might have 225 banks maybe merge or whatever. You're starting to see merger and activity starting to pick up again.
If interest rates are rising, and how would that affect the banks in your portfolio?
Well, very positively, because most of our banks, because they're community banks, are what we call spread driven, and that they make their money by what they charge on loans and what they pay on deposits. And so if rates go up, in general, when rates go up, loan rates will go up faster than deposit rates. Deposit rates tend to lag. So you get an increasing net interest margin. So the opposite, unfortunately, happens on the way down. On the way down, deposit rates usually fall slower than loan rates. So it's the other way. But rising interest rates, and rates just can't go any lower, but rising interest rates, and they will rise, whether it's next month or next year or 5 years from now. But rising interest rates definitely help community banks because they're much more what we call spread oriented. So that's going to be good. That's going to be good for community banks.
So it sounds to me like if somebody wanted to be in the banking industry, this would be, to me, a safer way to go, because these are underfollowed. People aren't aware of them as much. They may not have analyst coverage. So to me, that would be, even though they're small, to me that was even a more conservative way to maybe play it. Is that a correct way of looking at it?
I would agree that underfollowed might be an understatement. I'm trying to think of banks, of the banks we own. I don't know if even half of them have one analyst that covers them, and if they have an analyst that covers them, it might be a really junior analyst, So we actually are an uncovered thing, and we go out and fly out or drive somewhere and meet the management of a bank and look at, well, you're the first people we've ever had come in and see us, or something like that. So it's and it's fun. I'm a community banker by heart, so I know how it kind of works or whatever. Let me just reiterate though that the quality of management is probably the number one thing we look for. You can have all kind of numbers you want, but good people can make a good bank great. And unfortunately, mediocre or poor people can take a great bank and make it mediocre pretty darn quickly. So we look for good people.
To me, that would be the deciding factor, because you're be able to evaluate management probably better than any. I'm not saying any analyst, but you've been in the banking industry for so long, you know what it takes to make it work.
Yeah, that's why Jason and I believe, make a good team. Most bank funds are just run by analysts like Jason. But we're the only bank fund I know in the country which has what we would call an industry insider, somebody like myself who ran 3 banks, and someone who's a technical and analytical person. So I mean, last year we were positive. I mean, in a COVID year, we've been told by our friends in New York that we're one of the few, if not the only bank fund they know that was positive last year.
That's
You know,
impressive.
and so yeah, we were really we really had a we were really pleased last year on how we did, and of course we're off to a great start this year as well. But so we'll kind of see what happens. But no, Jason and I think are unusual on a team, and it's fun. I mean, Jason's a great guy too, and he's younger than I am. I love to work with young people like you and Jason, other
Like who?
like you.
I don't think we're very different in age.
Yeah, I'm a little older than you, and so
Maybe a little.
It's kind of fun for me to work with people a lot younger than I am. So.
Yeah, I have people working with me that are younger than me, and they're smarter than me too. So, or I'm not saying, but I do agree with you that having people around you that know more than you, or have higher IQs, or have better perspectives on things. I mean, I don't want to be the smartest person in the room with the people that work around me.
Yeah. Just want to be the richest, right? I'm not kidding.
I'll take that.
Yeah,
but,
right. Just kidding.
Well, we have to wrap this up, so we've got like another minute and a half to go. But if somebody wanted to learn more about the fund, how would they go about learning more?
Well, just contact me, whatever, or Jason. You can go on to Community Financial Institutions Fund.com, or just plug it in your system; it'll show up. But our minimum investment is $250,000, and we have no lockup. You can with 60 days notice, you can get your money back. So there's no lockup, which is unusual for a hedge fund.
Right.
And we have about 90 investors. We've had very few redemptions over the 6 years. Each year we keep adding a few investors, and so it's working out fine. Our investors are just really good people. They call us, we call them. I mean, we went through this whole COVID thing last year very well. Really had. Literally last year, I don't think I had redemption at all during the whole COVID thing, which was great. So
that's great. That's great. Well, Ted, thanks for spending some time with us today. We're gonna have to wrap it up.
Well, David, the other way. Thank you very much for having me. It's been a pleasure, and good luck with everything. I know DeWitt Capital is a great company. So.
Thank you very much. Well, have a great day.
Thank you. Bye-bye.
Take care.
Email us at investsmarterpod@gmail.com with questions to be highlighted on the show. Thanks for listening, and keep investing smarter.